We've got to talk about the dividend king that is Pepsi stock. It has recently been crashing and continues to fall off a cliff after posting what looked like astounding earnings. There is some hidden information that we have to divulge into to kind of figure out if Pepsi stock is truly a buying opportunity today, or if chip prices are just getting so expensive that potentially they are seeing the end of their growth cycle. Now, that is a conversation you'd appreciate. As always, hit that like button, folks, because Pepsi stock by far has been one of the best performing consumer staple brands that exists on the market. The price to earnings multiple right now is trading more at the level of a tech company, and with a 3.18% dividend yield, that is definitely at the higher range than we've seen in probably the last couple years. If we zoom in on the year to date, we can see the company from its recent peak has dropped 18.4%. And if you zoom out on the long term, there's only been a handful of times going past the 2008 financial crisis the stock has truly dropped this much, with one exception being the pandemic. Now, I want to do a quick comparable with Coca-Cola, because Coca-Cola has also been experiencing a sell-off. Now, is this something that is just cyclical, or is this something related to the fundamentals of the underlying economy? Now, Coca-Cola will be posting earnings toward the end of the month, and we'll have to come back and review those. But in comparison to these businesses, when it comes to dividends and security, what one actually looks better at face value? Because when we just take a look at Coca-Cola's profit margin sitting at 23.8%, when we take a look at their dividend payout ratio at 74%, incomparable to Pepsi, there is quite a variant difference, because the payout ratio is slightly higher at 80.5%, and the current profit margins on Pepsi are only 9%, meaning they have less margin to kind of feel the effects of this economic downturn. And these are rather premium products today. I actually like shopping at Walmart in their discounted dollar chip aisle over spending a $5 insanity on a bag of Doritos. And Doritos are one of my favorite chips, but there are other emerging brands that are proving to be competitive with Pepsi when it comes to things like Takis. There are other growing brands that are taking some of the market share, coming in at cheaper prices. Still a bit of a premium, but nothing like the Pepsi Classics. And taking a look at the dividend history, the last decade has been nothing but generous to shareholders, going from 45 cents a share to where it sits today at $1.27 is well over a doubling, almost a tripling of your dividend. So congrats to anybody that was able to sustain shareholdership over the last decade. Now, taking a look at that price to earnings multiple, yes, it hit a peak at that real tippity top back in 2023, more toward the beginning of the first quarter at 37 price to earnings, which just seemed astounding. But today we're sitting at about 26, which if we go back over its history, back in 2010, it was trading around a 10 times multiple. So we are definitely trading at one of the higher premiums for this company that it's seen pretty much in its history. And the question we have to ask ourselves, is that price to earnings multiple just? Because just taking a look a little bit deeper into the growth spectrum of this, and to see single digit growth, but at a multiple that is high as in the mid 20s, seems a little bit hard to stomach, considering most of this seems to be a cause of the pandemic. And we'll talk about some of the current pressures that that are keeping this growth rate up, because it has been slowing down. But we can see there wasn't a huge period of growth up until the pandemic hit, when everybody got stuck at home, probably doing a lot with snacking, and that seemed to drive a period where they saw a 20% increase in 2021. But driving a little deeper into those numbers, just based off the last quarterly filings, their net revenue hit $23.4 billion versus $21.9 billion this time in 2022. And taking a look at the 36-week from $63.6 billion to $58 billion is still an incredible growth metric, but you have to take all of this with a grain of salt. One of my biggest concerns with the company as it stands today is, unlike a tech company, they have a lot of debt. I mean, their total assets sit at about $100 billion, but they have about $81 billion in total liabilities. Of that, they have current liabilities of about $32.6 billion, with short-term debt obligations of about $8.9 billion, and really only just enough cash to basically cover that. Now, keep in mind, they do have some accounts receivable here, which is about $11 billion. But again, they don't have the same kind of room that, say, a company like Google or perhaps Apple would have to play around with some of their long-term and current liabilities. So that is something that is slightly concerning. That'll be an interesting comparable to the likes of Coca-Cola when it drops. But taking a look at basically every country that they're selling these goods in, just to see what's going on, with the vast majority of their growth coming from North America, with Frito-Lay in North America seeing some growth at 5.9 billion versus 5.5 billion. You got Quaker Foods at 747 million versus 713 million. The Pepsi beverages 7.1 billion versus 6.6 billion. So great growth. And when you get into Latin America and Europe, pretty much growth across the board, except for Africa, the Middle East, and South Asia. That could be more related to the geopolitical events that may have been hindering their potential growth into some of those conflicted, countries. But nonetheless, again, growth looks exceptional. And if you took this for face value, you wouldn't be getting the whole picture of the company, because on the recent earnings call, but Pepsi's volume, and we want to talk about the sales volume here, which stripes out pricing and currency change, fell again this quarter. Pepsi's price hikes to mitigate inflation have weakened demand for its products. The company has also been shrinking portions and making smaller value packs to drive more transactions. Pepsi's executives told analysts on the conference call that this strategy results in more affordable options for consumers and lower volumes sold. Pepsi's North American beverage unit reported volume declines of 6%. The CEO, Raymond, said that the company has pruned some promotions, such as for its bottled water business, in order to preserve margins. But those deals drove volume for drinks and gains that disappeared without those promotions. There was some bright spots in beverages, like Gatorade, for example, saw double-digit revenue growth. The company also plans to relaunch Mountain Dew Baja Blast, which is a fan favorite that is available in Taco Bell. The company's North American food division performed better than the beverage unit did. The Quaker Food North America volume rose 1%, while Frito-Lay North America's volume was flat. Quaker Foods brands also gained market share in key categories such as pancake mix and syrup, the executive said in the prepared remarks. Looking to 2024, Pepsi anticipates organic revenue growth on the high end of about 4 to 6% and core constant currency earnings per share growth in the high single digits. So just kind of digesting these messages, what we can really see going on is when it comes to core food categories, they are seeing growth, because in this higher interest rate recessionary environment, people are more likely to spend money on what they need, not what they want, especially when there's dramatic price increases. And I'm sure you've seen them on many of Pepsi's products when you go to a place like Walmart. So it's no surprise Quaker Foods is one of their growing segments. However, it's not the largest segment of productive income for them, right? So this is just one of these weird market environments we kind of have to ask ourselves, is Pepsi going to be able to sustain increasing, basically just shrinking the products themselves and keeping a higher price point, and if the market will sustain that moving forward, because it doesn't sound like a sustainable business model. And something tells me, if you take that into consideration, looking at that revenue growth, it could start to dwindle away, as again, they mentioned they're looking at around the 6%, which is looking like on the lower end of growth vectors compared to the last year or two. So this isn't something particularly we want to see in such a high price to earning multiple company. And again, with the margins they do not have, it's no surprise why they're cutting marketing expense. But again, we can only really try and determine if this is just a short-term period in a recessionary environment, or if it's something that has a long-term impact on their ability to grow, because these aren't companies that tend to like to do price cuts, but they're losing volume, which means there isn't much more new adoption as there is with their traditional base. It's something we see out of a lot of consumer staples, even though the likes of McDonald's. But I can't wait to see Coca-Cola's earnings, and I love getting exposure to this company. I think there's still a lot of long-term potential, but it's hard to understand if you're overpaying for it today based on these current metrics. And I get my personal exposure through ETFs like SCHD. I wouldn't over leverage into it, and I just be careful here moving forward, because again, these recessionary environments put a lot of pressure on companies that tend to trade at these higher multiples. But I'd love to know what you think in that comment section below.